Good morning, ladies and gentlemen. This is Alex, Senior Account Executive at GDMFX with this morning's European session outlook. We'll start with the North American markets. We had the ADP Employment Change for March come out 6,000 better than expected at 200,000. But this didn't help the dollar much. The weakening in the USD is a continuation of Yellen's dovish statement on Wednesday. She couldn't have hurt the dollar more if she tried, as her dovish comments continued to reverberate through the markets one day after her speech, taking the buck to fresh session lows against all of the major trading partners. The Dixie is down to 94.96 from 95.11. The USD CAD was the biggest mover with 90 pips down. USD Swiss franc ended basically sideways, but it had an 80 pip downwards range, and the USD JPY is 30 pips down. Today we have 3 events from the US, 2 from the US, 1 from Canada. Initial jobless claims for March 25th, Chicago Purchasing Managers Index for March, and GDP month-on-month for January from Canada. Alright, onto the European markets. Yesterday we had green numbers coming from Germany and Switzerland. Germany's CPI year-on-year came out 0.1% better than expected at 0.3%. The CPI month-on-month came out 0.2% better than expected at 0.8%. We also had the harmonized index of consumer prices month-on-month year-on-year, both coming out 0.2% better than expected. In Switzerland, the COF leading indicator for March came out with 1.6 points better than expected. Today's events will be quite important for the euro. We'll see the EU CPI year-on-year and core CPI year-on-year. Besides that, we have the ECB monetary policy meeting accounts. From Germany, we'll have unemployment data. Even though the Eurozone's consumer price index is anticipated to contract an annualized 0.1% in March, a pickup in the core rate of inflation may boost the appeal of the single currency and spark fresh monthly highs in Euro-USD as it limits the European Central Bank's scope to implement additional monetary policy. Alright, on to the UK markets. Tier 2 event yesterday. GfK consumer confidence came out 1 point better than expected at 0. Fears that Britain might vote to leave the European Union helped keep consumer confidence at the lowest level in more than a year, according to a survey published yesterday. The Bank of England said Tuesday that the prospects for financial stability have deteriorated as it put the risk of a Brexit following the June 23rd referendum at the top of its list of near-term domestic threats. Stability officials at the central bank warned the pound, which is already heading for its worst quarter since 2009, could fall further as uncertainty increases. The FTSE 100 is at 60.82. The 10-year gilt yields closed at 1.45% yesterday. We'll have the GDP data, GDP year-on-year and quarter-on-quarter data, consumer credit for February, and mortgage approvals data today from the UK. Besides this, Mark Carney will hold 2 speeches during the day. Alright, on to the Asian and Pacific markets, mainly Asia. Yen borrowing costs plunge as Japan's fiscal year end approaches. The annualized rate for overnight loans hits negative 2.5%. This is the lowest since 1998. We had the Japanese foreign investment in Japan stocks come out 319.5 billion yen, better than previous. And the foreign bond investment is 1,000 billion better than expected. The housing starts are 7.6% better than previous. And the JPY annualized housing starts are 101,000 better than previous. Tonight we'll have a slate of manufacturing data from Japan. Last sector for the day, commodities. Oil closed near $38 a barrel in New York as the dollar's loss eased, reducing the appeal of crude as a store of value. Futures retreated from the day's highs along with the Standard & Poor's 500 index. A strong dollar curbs investor demand for commodities. Prices surged as much as 4.1% after a government report showed U.S. refineries processed the most crude since January. American crude supplies rose, keeping stockpiles at the highest level since 1930. Gold retreated on Wednesday, giving back more than half of its recent gains as investors turned their attention to a climb in the U.S. stock market. However, the metal's descent was kept in check in the near term as expectations for cautious moves by the Fed on interest rate policy dent the dollar. Alright, that was all for today. Thank you for the attention. I'll see you next time. Goodbye.